Well, the Federal Reserve raised short-term interest rates as expected earlier this week. Rob Morgan, Chief Investment Officer at Sandy Spring Break, joins us now. Welcome back, Rob.
Hey, thanks, Leah.
All right, so do you think the Fed is making a mistake by really not taking into account the latest weak inflation reading?
Well, they say that this weak inflation reading is and the weak employment and economic reports in general will be transitory. They think, well, they think that the economic growth is going to pick back up to its previous levels, and that's going to spark a little bit of inflation. That's what they're saying, and of course we won't know until after the fact if they were correct. So I think I've got to take them at face value on this.
The bond market is saying something else. If you look at the yield on the 10-year Treasury, 2.16, 2.17%, this is the fourth lowest level of the year. We're also seeing the yield curve flatten. Moral of this story is the bond market saying the economy is not so good.
And,
right.
And a lot of people are saying the stock market is saying one thing, and as you said, the bond market's saying another thing, because typically they don't act. You know, stocks are doing well, bonds are doing well, even though the yield's low. That means the price is going up. So what gives there? And I think really clearly with stocks, it's the earnings recovery. That's what's driving that. But with bonds, it's this global demand for yield. I don't think it has anything to do with weak economic growth. The economy's sputtering, what have you. So it's a global demand for yield, and of course the U.S. continues to be the safe haven with all this political strain going on around the world.
That's interesting. So overall, what sectors do you like right now for investors, and which ones do you recommend they avoid?
So I continue to like financials because I think we will have a steepening yield curve eventually, even though we're not seeing that right now. That's probably my favorite sector. I also like consumer discretionary and technology, and then I would avoid healthcare. You know, there's this continued talk about compressing prices, what have you, and then the commodities as well.
What about tech stocks right now, though?
Yeah, even though tech has suffered these last few weeks, I think it's a bump in the road, and they'll regain their mojo.
Let's talk a little bit about tech stocks. The technology sector obviously is huge, and we seem to focus on the popular momentum stocks, the FANGs, add Microsoft and Apple in there. Outside of those stocks, is tech healthy?
I think overall it is. I think we do focus on those momentum names. Those PE ratios are pretty high. You know, our shop would tend to be more in, say, the Apples of the world. It's a little bit more of a reasonably priced, I'd say.
So we just saw a big sell-off. What do you think was really behind that?
Well, I really think that the market, that segment of the market had just gotten ahead of itself. It was up 16% before the slide. It was the best performing sector in the S&P. And I do think with some of the earnings reports, maybe some of the forward guidance was a little bit shaky as well.
All right. Thank you, Rob Morgan. Thanks for being with us.